Hi everybody, welcome to another update on the stock screener. Today we're going to look at Geopark. I read this post about Geopark having 3 times free cash flow, 50% returns. Okay, in Colombia. So let's take a look. Looks great. Went down 50%. Maybe this is a buy, I don't know. So let's confirm that this is a buy. Geopark, Colombia, also Ecuador and Brazil. I have my sheet ready to fill in. And let's see if it pans out like this Marhelm says. So let's start with the balance sheet. US dollars. So here we already can see financial expense 12. Yeah, let's say there's also some income. Let's say 11. Let's say 10 million. Yeah, 10 million in expenses, financial expenses, times 4. So that's 40 million in expenses. Okay, 40 million in interest expense. This might go down if they are profitable. We'll see. Administrative expense, 11 million. Some selling expense as well. Then we have the operating costs. Yeah, selling expense and administrative expense, let's say 15 million per quarter. I will put that here. Geological expense. Yeah, that could be 16 million then. I won't do depreciation. That's not really cash that's going away. It might reduce tax, but okay. Let's ignore this for now. Other income, yeah, let's ignore that as well. Income tax expense. Yeah, that's a pretty high tax. 41 divided by 66 is that's a lot of tax. How is that possible? Let's take this one. 70 divided by 104, that's 50% tax. 143 divided by 315. 50% tax. That's a lot. Unbelievable. I might even have to increase this. Yeah, but there's also depreciation. Let's just stay with the 40% tax. That's high enough for me. Because there's also depreciation. Then let's look at the balance sheet. So on the balance sheet, we have current assets of 209 million. Is 209 million. And liabilities of 815 million. Yes? And that's already the first problem I have with this. Yeah, I didn't talk about cash. It yeah. He only talks about market cap and free cash flow. Operating net back exceeding market cap. But he didn't look at enterprise value. That's important. There is 800 million in debt. Well, not debt, but liabilities. Borrowings. 500 million borrowings. That's a lot compared to the current assets of 200 million. That's a lot of borrowings. Deferred income tax, long-term liabilities, another 100 million, 600 million, and more borrowings and tax liabilities and other payabilities, 800 million. So this is actually a pretty high enterprise value, because this just adds 600 million in net liabilities. So how many shares outstanding? Doesn't say how many shares are outstanding. Maybe here. Nowhere. Oh, number of common shares. 5 billion shares. 5 billion shares. Uh, 5 billion doesn't make any sense. Because here it says repurchase 10% of its shares outstanding, which is 5 million. How can it be 5 billion then? This is 20% of shares outstanding times 5 is 500 million, 600 million. So this is not correct. Oh, this is the number. 56 million shares. 56 million, around this number. 56 million shares. Share price 8.91 times this. So we have an enterprise value of 1.1 billion. 1.1 billion. So this times 2, okay? So if you just look at market cap, then it seems cheap, but actually you need to double it because the enterprise value is 1.1 billion. So that's the first problem I see here. It's not 3 times free cash flow, it's 6 times free cash flow. Okay. Let's continue looking deeper. Production is 10% up, that's good. Oil and gas of 38,315. 38,315. Probably this will be the same in 2024. Yes. And that's about this number per year. Let's just put it like this. Exit production 38, yeah, around the same. Good success rate. Okay, production guidance of 38 to 39. Yeah, I will give it 39. Not a lot of growth, but okay. Okay, capex of 170 million. 170 million, so that needs to be taken into account. of capex. So this plus this is 235. So 235 million capex. Let's just assume it's going to be the same. Capex plus SG&A. EBITDA 400 million. I have 250 million free cash flow, but I don't have all-in sustaining cost yet, so I need to know what the costs are. Most of it is coming from Colombia, as you can see here, and most of it is oil. So that's easy. It's basically just oil. Yeah. Some gas in Brazil and Chile, but yeah, most of it is oil. Let's say 90%. 93%. Basically just 95% oil. Okay, now we look at the earnings. What is the cost? Do they have some cost numbers? $44. That's 200. Yeah, that's correct. Production. This is important. Realized price per BOE is 68. 68. And Brent oil was 86. So that's about 10. Yeah, about $10 lower than Brent. $8 lower. Okay, I will take $8 lower than Brent. I will say here Brent. Actually, $8 lower than Brent. $8 lower than Brent would be 71. So $3 lower than crude oil. Let's take $3 lower than crude oil. So $3 lower than WTI is the price that they get. So 71. Okay, 71. Everybody okay with that? Okay, now the cost. revenue, production and operating costs, 58. Do they have per barrel? Not per barrel, but okay, here is per barrel. So operating costs per barrel, 15.3, 50 purchased crude oil, selling and other. Maybe this is the selling and other. I won't add that. Purchased crude oil. Not sure what's that. Let's just take this and this. 16. 16 per barrel. That's low cost because you have 70 and 16. That's a very good cost. Royalties 5.5. 5.5 divided by 68.4 is 8%, but here it was 18.8, 24%. So not sure why royalties are different here. Very odd. They are all over the place. Let's take Q2. Royalties here are 8.8 divided by 59. 15%. 15%. 24, 90, 26%, 15%, 8%. I have no idea. It's around. Maybe it's a scale with the oil price. Let's say we are at current price at 68, around that number. So the royalty is, let's say, 10%. To make it more conservative, 15%. 15% royalty. Yeah, I put that here. %15 royalty. Okay, what do we need else? Yeah, the revenue was 68.4 in Q3. So that gives a very nice net back. Maybe we should check the revenue as well. Is annual production divided by 4 times 68.4, 240 million revenue. And I have 200 million here. Yeah, but it was 34778 production. 34778. Not sure why it was lower, but yeah, that could be correct. So 34778, and now it's higher, 38. Okay. Good. Next up, what's the production growth? Looks pretty flat. Doesn't look exciting. Ten years reserve life. In Colombia. Yeah, Colombia is the biggest asset, so 10 years. 10 years of life. Has gone down. Oil production is going down. So that doesn't look that great. It looks like this production is not going up. So that's a problem. 6 years life. A lot of, yes, too much data. Too much data. Just give me the production guidance. Going to be flat. Costs are actually going up. 12, 13. Now it's 16 even. Yes, it is low break even. That's true. But what's the capex? 170. So this is the capex. and this is the net back, and we get about 300 million per year free cash flow. 300 million per year. I don't think so. It's just 100 million on my sheet. Why is it only 100? Brent 80 to 90. Brent 80 to 90. 85. Yeah, it's not at 85, it's at 79. So that's $7 lower. So they think that it should be 80. Yeah, still I don't see it. I still have only 200 million free cash flow. How do they get to 300 million? Okay, this is cash flow, but probably before tax. After tax, it's going to be lower. Yeah, that's probably it. This is before tax. And I have calculated it after tax. We have 60%, so 40% tax. Yeah, you need to calculate the tax as well. This company pays a lot of taxes. We saw 50%. Free cash flow, yeah. 160 million. Oh, here we have taxes, yes. So 130 million free cash flow. That's exactly what I have here, 130 million free cash flow, okay? So we are correct. Production is going to be the same. It's not going to grow. So basically we have all the numbers now. This including royalties, capex, interest payments. Income is about 100 million, so they could pay off. Yeah, they should be able to pay off debt. So I will reduce this maybe like this. And they will be debt free in a few years from now. And this is our chart. This is our NPV chart. Okay? It's as easy as this. All automated. And here we have the 5 times free cash flow chart. And we see that, yeah, this is the market cap. We should not use the market cap because this is a highly indebted company. We should use the enterprise value, which I'm going to add here. Enterprise value is market cap and it's 1 billion. So from here we went to here because of the enterprise value. Looks like an interesting company to put on the sheet. Here. A lot of companies. Did we fill everything in? I think so. So at the current price of 71 WTI minus $3, we are overvalued. Yes, because the enterprise value is double the current valuation of 5 times free cash flow. So it's at 10 times free cash flow now. Okay, this company is very good because it has very low break evens. It won't go bankrupt at 60. It will always make money. So that's the great thing about this company. It will make money. If oil goes up, then it will make more money. But there is not a lot of leverage, I think. Yeah, there is not a lot of leverage here because it's overvalued. And here you can see it as well. It's overvalued. You will never reach your enterprise value. Not even in 10 years. That's not a good company. I think this could drop. I think this could drop 10, 20, 30% in enterprise value. So that's 300 million in a drop. 300 million in drop. If you look at market cap, that's 50%, more than 50% drop in Geopark market cap is possible. So I would not buy this company. It's overvalued. Why? Because there's so many liabilities. And it's still overvalued. So if this drops down, the enterprise value drops down, market cap will drop down even faster. Yeah, and that's a problem with highly indebted companies. Market cap 500 million, but this is 1.1 billion in enterprise value. Of course, if oil goes up, then Geopark could get to fair value, but it's a stretch. It's a stretch because we need to go to at least 100 oil. Let's try something. Let's say 90. 9. Okay, 90. 90 looks better. Could be upside of 30% here, which means that the market cap goes up 50%. So actually very leveraged to oil. Yeah. So you need a high oil price with Geopark. And it has not done well because production went down, still going down, too much debt, and oil prices are also down. Oil has gone down this year, not done anything from 81 to 74. So that is why Geopark is also down. Okay. Would I buy this? No, I will not buy this because it's overvalued at current oil prices. If oil goes up, then I would buy it, but oil is down, so I won't buy it. We buy companies when they are undervalued with upside potential, additional upside potential in oil. If this were now already like this, NPV going here, then I would buy it with additional upside potential for oil to go to 90. Then it would go from here to here. That is a company that I would buy. I'm not buying a company that's already overvalued right now. So that's the assessment of Geopark. Nice try, but I'm going to tell you the following. The problem with Geopark is that they do have quite a lot of debt. So looking at market cap is not a good strategy. And that's it. I'll see you in the next video. Bye.